The trade that damages you most may be the one you place immediately after you feel you must trade. The market may be open, your setup may look familiar, and the price may even move in your direction, but your judgment has already been compromised. The danger did not begin with the order. It began with the condition under which you decided to place it. There are two trading times that deserve unusual caution, and neither is defined solely by the clock. They arrive when your perception of risk becomes distorted, once by emotional pressure and once by emotional confidence. In one, you feel compelled to recover something. In the other, you begin to believe you have earned the right to press harder. Different feelings, same result. The trade starts serving the trader's state of mind instead of the market's behavior. This is why a sound method can still produce a reckless decision. A setup does not exist in isolation. Consider what happened before it. Were you stopped out and now looking for a quick re-entry? Did you just close a strong winner and suddenly notice opportunities everywhere? Has your position size changed, even though the quality of the evidence has not? When urgency rises faster than clarity, the difference matters. Watch your behavior before you study the next candle. Notice whether you are shortening your confirmation process, moving from selective entries to frequent ones, or interpreting ordinary price movement as proof that you must act now. These are not small habits. They are signs that your internal tempo has separated from the market's tempo. Once that happens, you tend to enter before conditions mature, hold because you need vindication, or add risk because restraint feels unnecessary. The market does not punish emotion as a moral failing. It simply exposes the decisions emotion produces. Impatience causes early entries. Frustration increases size or frequency. Confidence turns a reasonable hypothesis into assumed certainty. Each cause leaves a visible footprint in execution, and those footprints can be observed before serious damage is done. So before placing the next order, ask what has changed the market or your need to participate. Check the distance to invalidation, the available liquidity, the quality of confirmation, and whether your planned risk still fits your limits. If the trade only appears urgent because of the trade before it, stepping aside is not hesitation. It is discipline preserving capital for clearer conditions. But these two dangerous times do not announce themselves in the same way. One feels like pressure. The other can feel like mastery. And that second feeling is often harder to question. To recognize them early, you must learn the particular sequence of thoughts and market behaviors that appears just before each one takes control. A loss can remain active long after the position has been closed. The order is gone. The risk is settled. Yet part of your mind still treats the trade as unfinished. You keep watching the same market, not because it has presented something new, but because your account balance now feels like a problem that must be corrected. This is the revenge window. It begins when a realized loss is quietly converted into a personal debt. Once that happens, the next trade is given a duty no trade should carry. It must repay the last one. Price is no longer being judged only by what it is doing. It is being judged by whether it can remove the discomfort left behind. The market, however, has no memory of what you lost. It does not know your entry, your account balance, or the amount you want returned. The next price movement is independent of your previous result. But when the loss feels personal, you may begin to act as if the same market owes you compensation. That is why revenge often fixes your attention on the instrument that caused the loss. You want the correction to come from the same place as the injury. It feels cleaner that way. You imagine that winning it back in the same market will prove that your original judgment was not entirely wrong. What you are seeking is no longer merely profit. You are seeking reversal of the verdict. Watch how the loss changes your private definition of success. Before the trade, success may have meant following a sound decision. After the loss, success begins to mean returning the account to a particular number. If the account is down 500, then 500 becomes the hidden target. A smaller gain feels incomplete. Another loss feels far larger than its financial amount because it increases the distance from emotional relief. This creates a dangerous form of mental accounting. You stop treating each trade as a separate exposure and begin combining several trades into one private campaign. The first loss becomes the opening event. Every position afterward is measured against it. Because the campaign must end in recovery, accepting another unfavorable outcome becomes harder, and the past begins to govern decisions that should belong only to the present. You can detect this window by listening closely to the words forming in your mind. I need it back. One good trade will fix this. I cannot finish the day here. These statements reveal that your objective has changed. You are no longer responding to price. You are negotiating with a result that has already happened. Ask yourself one severe but useful question. Can you accept the account exactly where it stands, without requiring the next trade to repair it? If the honest answer is no, then the loss is still controlling the purpose of your next decision. Until the loss is accepted as complete, every new position remains connected to an old wound. A losing trade can create the demand to be repaid, yet the opposite result creates a different distortion, one that rarely feels like danger when it first appears. A profitable trade can be more misleading than a losing one when it rewards a decision that did not deserve to be rewarded. The money arrives, so the mind closes the case. What should have been examined is accepted as proven, and confidence grows around an error that remains hidden. Profit answers only one question: did this trade make money? It does not tell you whether the analysis was sound, whether the risk was justified, or whether the result depended on a favorable event you did not anticipate. Markets sometimes pay careful judgment, and sometimes they pay careless judgment. The account records both gains in exactly the same way. The overconfidence window opens when you claim full credit for everything that went right. You remember the part you understood and quietly ignore the part that surprised you. If price reached your objective by a path you never expected, the outcome may still be favorable, but the forecast was less accurate than the profit makes it appear. A win also changes the memory of the decision. Before entering, you may have felt uncertain. Several outcomes may have seemed possible. After the gain is realized, the correct outcome begins to look obvious, and your original hesitation becomes difficult to remember. The finished chart appears orderly because you can now see where price went. That knowledge makes your earlier judgment seem clearer than it truly was. This matters because rewarded errors are difficult to remove. A loss naturally attracts inspection, but a win often escapes it. If an unsound assumption produces a gain, you may carry that assumption forward with greater conviction. Repetition then turns a fortunate result into a false principle, and the weakness is discovered only when market conditions stop protecting it. Overconfidence does not always sound like boasting. It often appears as certainty in your explanation. You stop saying that one outcome was probable and begin speaking as if the market behaved according to your understanding. When later evidence conflicts with that story, you explain the conflict away rather than questioning the story itself. The stronger your attachment to being right, the less information you are able to receive. To examine a winning trade honestly, remove the profit from the evaluation for a moment. Reconstruct what you knew before the entry. What movement did you expect? What conditions did your reasoning depend upon? Which developments were anticipated and which merely worked in your favor? If you predicted the destination but misunderstood the journey, the gain should not be treated as complete confirmation. It helps to separate a good outcome from a good decision. They can occur together, but they are not the same thing. A sound decision may lose because uncertainty cannot be removed. A weak decision may win because uncertainty can temporarily be generous. Your task is to identify which one the market just paid. Ask yourself, if the final result were hidden, would you still approve of the reasoning that produced the trade? If not, the profit has supplied money, but it has not supplied evidence of skill. Preserving that distinction keeps one favorable result from becoming a license for careless certainty. Yet when a win goes unexamined, its first effect is often not visible in analysis. It appears in speed. The trader begins to feel that waiting for full confirmation is no longer necessary, and that is where the next danger starts. Urgency rarely enters your thinking as panic. It arrives as a reasonable, sounding argument. If you wait, The price will move without you. The chart appears close enough, the setup appears almost complete, and you begin treating the final piece of evidence as a formality. Confirmation always has a cost. You may receive a less favorable price, or the market may move away before giving you an entry. In return, confirmation gives you information. It shows that price has done something rather than merely approached the place where you hope it will do it. Urgency notices the cost of waiting and forgets the value of knowing. Anticipation and confirmation can look nearly identical while a trade is forming. Price may be one tick below a breakout level. A candle may be moving strongly, but still have time left before it closes. A test of support may appear to hold before fresh selling arrives. The distance between nearly and completed can be small on the chart, yet enormous in the logic of the trade. Suppose your plan requires a candle to close above resistance. Price moves through the level during the candle, and you enter because the close seems inevitable. If price falls back before the candle finishes, you did not take a failed, confirmed breakout. You entered a breakout that never existed. The distinction matters because the market did not violate your signal. You acted before the signal was created. A premature entry therefore changes more than the timing. It changes the proposition you are trading. Your plan may be built around proven acceptance above a level, but your order is now exposed to uncertainty at that level. The trade on the screen may resemble the trade in your plan, while the evidence beneath it is entirely different. Once money is committed, the mind also loses some freedom to observe. Information that would have been neutral now affects your position. A weak close becomes something to excuse. A rejection becomes something you hope will reverse. Because urgency placed you inside the trade too soon, you begin interpreting the unfinished setup from the position's point of view. Make your required confirmation visible before price reaches the decision area. Describe it as a completed event. Price has closed above the level, the retest has held, or the rejection has finished. Precise language protects you because it leaves less room for desire to convert, approaching, into, confirmed. At the moment you feel pressure to act, ask one narrow question. What fact exists now that did not exist one candle ago? If the answer is only that price is moving faster, getting closer, or looking stronger, then you may be responding to intensity rather than evidence. Confirmation does not remove uncertainty, and it does not guarantee the trade will work. Its purpose is more disciplined than that. It establishes that the event your decision depends upon has actually occurred. Without it, you are not accepting normal market risk. You are trading your expectation that the missing evidence will soon appear. This substitution becomes especially difficult to detect when a position has just ended and the same chart immediately seems to offer another chance. In that brief interval, urgency takes on a sharper form. The impulse to enter again before the previous trade has released its hold. The first trade leaves the screen when you close it, but it rarely leaves your vision at the same moment. For a short period, every new price movement appears connected to what just happened. The chart is still in front of you, yet you are no longer seeing it with fresh eyes. Immediate re-entry is not automatically a mistake. At times, the market can present another valid decision quickly. The danger is that the second trade may inherit the viewpoint of the first. Instead of beginning with current conditions, your judgment begins with the position you recently held. Your former entry, exit, and unrealized high or low become powerful reference points. They carry personal meaning because money changed hands there, but personal significance and market significance are not the same. A price matters technically only when market behavior gives it importance. Your memory alone cannot turn it into support, resistance, or opportunity. After an exit, new candles are often interpreted as comments on the old decision. If price returns in your original direction, it can seem to say that you left too soon. If it moves against the old position, it can appear to confirm that your exit was correct. In both cases, you are reading the present through a trade that no longer exists. This creates what may be called a chain decision. The first trade supplies the story, and the second trade continues it without being judged independently. You may tell yourself that you are taking a new position, but the underlying idea has never been reset. Because the boundary between the two decisions is blurred, weaknesses in the first analysis pass quietly into the second. The problem becomes sharper when market character has changed during the first trade. A steady movement may have become unstable. A clean range may have begun to expand. Participation may have shifted from orderly to erratic. If you re-enter from the old viewpoint, you may apply yesterday's logic to conditions that changed only moments ago. Before entering again, try describing the chart as if you had not taken the previous trade. Do not mention where you bought, where you sold, or what the earlier position earned or lost. State only what price is doing now. If the case for entry becomes weak when the first trade is removed from the story, then the second trade is probably dependent on memory rather than present structure. You should also be able to classify the new decision clearly. Is it a continuation of the original thesis, a reversal based on changed conditions, or an entirely separate setup? Each requires its own reasoning. The word, gain, is not a thesis. Neither is the feeling that the market has returned to give you another chance. Look closely at any level that attracts you immediately after an exit. Why does that price matter? Has the market repeatedly reacted there, or does it matter only because your former order was placed there? This distinction is easy to overlook because account history remains vivid while market structure can be less emotionally visible. A true second trade must be capable of standing alone. Its logic should survive even if the record of the first position were erased. Otherwise, you are not making two decisions. You are extending one decision through multiple orders, allowing the past to keep directing capital after its original authority has ended. And once separate trades begin to feel like parts of a single campaign, another temptation appears, changing the size of the next position so the entire sequence can produce a more satisfying result. A trade can be reasonable at one size and reckless at another. The chart has not changed. The entry, invalidation point, and uncertainty are identical. Only the quantity is different. Yet the difference can transform a manageable decision into one you are no longer able to execute calmly. Position size should be the result of a calculation. It translates the distance between entry and invalidation into an amount of capital you are prepared to risk. When that distance is wider, the quantity must usually become smaller. When it is narrower, the quantity may be larger. In either case, the market structure comes first and the size follows. Emotional sizing reverses that order. You begin with the amount you want to make, then choose enough quantity to make that outcome feel meaningful. Risk is no longer controlling the size, desire is controlling it. Because the calculation starts with reward, the possible loss is treated as an inconvenience to be adjusted later. Strong conviction often provides the excuse. You may tell yourself that this setup is clearer than usual, or that the movement has unusual potential. But confidence is not a measurable market condition. Unless the evidence, invalidation distance, available capital, or predefined risk category has changed, there is no objective reason for quantity to change. Size also affects perception. A normal fluctuation feels different when every tick carries more money than you are accustomed to seeing. Small movements become emotionally heavy. Attention narrows, patience weakens, and the position begins to demand constant interpretation. The market is behaving normally, but your exposure makes normal behavior feel threatening. This creates a quiet contradiction. You increased size because you claimed greater confidence, yet the larger exposure may leave you less capable of tolerating ordinary uncertainty. You may take a profit too early because its monetary value looks large, or interfere with the loss because accepting it now feels too expensive. The position becomes harder to manage precisely because you wanted it to matter more. A disciplined sizing process begins with the maximum acceptable loss, not the desired gain. From there, measure the distance between the proposed entry and the point that proves the trade idea wrong. Dividing the acceptable loss by that distance gives a basic quantity limit, with transaction costs and possible slippage considered where relevant. The purpose is not precision for its own sake. It is to prevent emotion from deciding how much uncertainty you will carry. Whenever you feel tempted to increase size, require an objective explanation. Which measurable input changed? Did the invalidation distance become smaller? Did your predefined risk plan assign this setup a different category? Did available trading capital change? If no input changed, then the larger quantity is not a new calculation. It is an emotional override. The order ticket should never be the place where size is negotiated. By that moment, the number should already be known. A hard limit, established away from the pressure of execution, removes the need to debate with yourself while price is moving. It also prevents a brief feeling from creating exposure that remains after the feeling passes. Ask yourself whether you would still choose the same quantity if the possible profit were hidden and only the possible loss were visible. If the answer changes, your size may be serving anticipation rather than discipline. Once exposure becomes larger than your mind can carry comfortably, price begins to look different. Ordinary movement seems unusually important, and soon nearly every fluctuation starts presenting itself as a signal or an opportunity. The market can move without offering you a trade. Price may rise quickly, fall sharply, or travel a considerable distance while presenting no decision that fits your method. Movement is constant. Opportunity is conditional. Confusing the two is how activity begins to look like evidence. A price change becomes meaningful only through context. Location matters. Structure matters. The amount that must be risked in relation to the reasonable objective matters. A strong candle in the middle of a disordered range may be less useful than a modest reaction at a well-established boundary. Speed attracts attention, but attention does not create value. When every move begins to look tradable, the hierarchy of information disappears. A minor bounce receives the same importance as a major rejection. A brief acceleration is treated like a sustained change in control. Large and small events are placed on the same level because the trader is searching for reasons to participate rather than distinctions that justify participation. This produces contradictory interpretations. If price rises, you see continuation. If it falls, you see a bargain. If it pauses, you see preparation for a breakout. Every condition supports some trade, so no condition can disqualify one. What appears to be flexibility is often a method that has become impossible to test. A useful setup must exclude far more movement than it accepts. Its strength comes partly from what it refuses. If your definition of opportunity can be applied to almost every candle, it is not identifying a special condition. It is merely giving a trading name to ordinary fluctuation. The middle of a range offers a clear example. Price can move actively there, producing several convincing candles in both directions. Yet buyers and sellers may still be operating inside an established balance, with neither side gaining lasting control. The movement is real, but its location gives it limited meaning. Without that distinction, energy is mistaken for direction. You can protect selectivity by defining disqualifying conditions as carefully as qualifying ones. State where you will not act, which structures are too unclear, and what relationship between entry, invalidation, and objective is unacceptable. A rejected trade is not a missed opportunity when it never met your conditions. Try describing a possible trade in one sentence. This behavior, at this location, changes this part of the market structure. Each part should be specific. If the sentence only says that price is moving strongly or appears ready to continue, you have described motion, not an opportunity. It is also useful to compare the current move with the surrounding market. Is it distinct from the recent noise, or merely another swing of similar size and duration? A movement gains importance when it breaks the established pattern. If it does nothing new, then the excitement may exist in the observer rather than in the price action. Selectivity depends on contrast. You must know what ordinary behavior looks like before unusual behavior can carry meaning. The trader who labels everything important eventually loses the ability to recognize what is truly different. But when ordinary movement repeatedly feels exceptional, the deeper question is not only what the market is doing, it is whether the market has reached its moment, or whether your own internal clock has decided that the moment must be now. The market and the trader often keep different clocks. The market moves when pressure develops, liquidity shifts, and positions are forced to adjust. The trader moves according to boredom, expectation, available screen time. and the desire to make the session feel productive. Trouble begins when the second clock is mistaken for the first. Market timing is measured by events, not by how long you have been watching. A range may require hours to resolve. A trend may pause longer than expected before continuing. Nothing becomes ready simply because a certain number of minutes has passed. Elapsed time can provide context, but it cannot complete an unfinished market process. Emotional timing begins when waiting creates a sense of entitlement. After studying a chart for 2 hours, you may feel that the time should produce a trade. The longer you have watched, the harder it becomes to leave without acting. Yet time spent observing is already spent. It does not improve the quality of the next decision. Your personal schedule can create the same distortion. Perhaps you have only 30 minutes left before you must stop. That deadline is real for you, but it does not accelerate the market. If you allow the deadline to influence your judgment, a condition that looked incomplete earlier may suddenly appear acceptable because your opportunity to participate is closing. This is how a trader begins forcing calendar time onto market development. A move is no longer judged only by its structure. It is judged by whether it arrived soon enough to fit the day. Because the market cannot meet a private deadline consistently, the trader starts lowering the standard to make the timing fit. Boredom adds another pressure. Quiet price action can feel empty because nothing appears to be happening. But inactivity on the screen may be part of the market's work. Orders are being absorbed, positions are being built, and neither side may yet have enough strength to establish control. When you demand visible action before that process matures, you trade your discomfort with silence. The practical distinction is simple: measure progress by what the market has completed. Write the sequence your idea requires. A boundary must be tested. A response must develop. One side must show that it can hold or extend control. Until the next event occurs, the setup has not advanced, no matter how much clock time has passed. Use a fresh view test. Ask yourself, if I had opened this chart only seconds ago, would I consider this condition ready? If the answer is no, then the hours already invested may be influencing the decision. The chart should not become more persuasive merely because you have been staring at it longer. Treat your trading session as a period in which you are available, not a period in which the market is required to provide. Availability gives you permission to act when conditions develop. It does not create an obligation to act before the session ends. If the market's process extends beyond your schedule, then the decision belongs to another time. The separation is clear in principle, but rarely obvious in the moment. Emotional timing leaves small traces before it takes control. In your language, your attention, and the way your hand approaches the order, and those warning signs appear earlier than the trade itself. A poor trade often reveals itself before the order is placed. The warning is not always fear, excitement, or any emotion you can easily name. More often, it is a small departure from your normal procedure. You begin doing something you do not usually need to do when a decision is clear. One early sign is that analysis turns into a search for permission. At first, you examine both sides of the market. Then a preference forms, and your research becomes selective. You stop asking what the evidence means and begin looking for one more reason to support the action you already want to take. Timeframe switching can expose this shift. The original chart does not support the trade, so you move to another interval. If that view also fails, you search again until one picture agrees with you. The problem is not using several time frames. The problem is changing them without a planned purpose, then accepting whichever one gives the desired answer. Adding tools at the last moment can serve the same function. An indicator that was not part of the original method is suddenly consulted because the existing evidence feels insufficient. Another line is drawn, another measurement is introduced, and complexity increases until doubt is covered. When a trade requires new rules to become acceptable, the trade is directing the method. The order ticket itself can become a warning. You begin entering the symbol, price, or order type before the analysis is complete. This seems harmless, but preparation creates commitment. Once the order is nearly ready, abandoning it feels like giving something up. The hand has moved closer to action, and the mind begins supplying reasons to finish what the hand started. Listen also to the shape of your reasoning. A sound decision can usually be stated plainly. A compromised one often has a vague central case surrounded by many explanations. The reason to enter becomes shorter while the number of exceptions grows. If you must repeatedly explain why unfavorable details do not matter, the resistance may be coming from the evidence itself. Your screen behavior may show the change before your thoughts admit it. Rapidly moving between charts, repeatedly adjusting a proposed entry, reopening a closed order window, or checking the same data without learning anything new are forms of procedural agitation. The activity creates a sense of work, but the decision is no clearer than it was before. These signs do not predict whether the market will rise or fall. They reveal whether your decision process is still under control. A trade placed through a weakened process may still make money, just as a disciplined trade may lose. The warning concerns the quality of the action, not the certainty of the outcome.